All right. Let's kick things off here. Thank you for joining us this December morning. Hopefully everybody's a little bit warmer than I am, though that being said, here in the Midwest it was 50 degrees yesterday, and I don't know what to do with myself with it being 50 degrees in the month of December. So the reason we're here today is to talk a little bit about taxes and some tax both planning and preparation tips that you can take going into the last couple weeks of the year here to get really ready to start 2025 on a high note, on a very organized and well prepared note. My name is Louisa Elzy. I am our VP of Tax. I don't have my headshot on the screen like we often do, but I have been with Club Capital almost 2 years now, and my background is in all tax, outsourced accounting, outsourced controller, the nitty gritty type, and so excited to share a few tips with you today. So who's Club Capital? I think everybody here is already a member. So you're familiar with this. So I'll go ahead and skip past this. But the nuts and bolts is we work with insurance agents just like you every day of the week. We're going to go through just a couple pieces today. The first one is just why it matters to kind of do this end of year prep, looking ahead to next year. What are some key best practices going into the next year? And then for 2025, what are some upcoming changes to keep in mind as we're leading into the next year? For changes, things to watch out for. And at the end, we will do any Q&A. Please use either the chat or the questions and answers feature here in Zoom. I've got both pulled up. So I will keep an eye on that and try if they're coming in real time. I might answer them in real time. If I miss them, because I just get so excited about taxes, I lose track of things. We'll circle back to them at the end. So please drop questions in if you have them, so that we can answer those specific questions too. So first, just why do I need to prep for end of year? I'm used to taking my stuff to my accountant, at the beginning of the year. They always get it done. So why is it so important to get prepared now, before the next year starts? And the big thing is just being ahead of the game, giving yourself more power and more ability to react. So the first one is organization. Anytime you are organized when it comes to your business, leading into not just taxes, but business decisions, things like that, being ahead of the game, thinking through things like, hey, what credit card statements do I have? What expenses did I have that I maybe didn't put on the business card that are absolutely business expenses? Did I get a new line of credit or a new loan that I haven't put onto my books yet? Did I decide to buy a vehicle? All of those things, the sooner you're thinking about them, the better, because it gives you the time to move through and get those updated. And kind of leaning off of that is the second, which is giving you time for a thorough review. We don't want What you don't want is to be finalizing your tax return, either in April or in October if you extend, and seeing your numbers for the first time. You want to have the time to think about things and make sure that you have captured all of those other expenses, whether it's, like I said, things on a personal card, and understanding. So not only time for a thorough review to make sure that you are complete, that you've provided your accountant all of the details that you had through the year, but also for you to make sure that everything makes sense to you, that you are comfortable with how things have gone, how the year went. And if you're thinking something like, wow, I made a lot more money than I thought, where did my money go? Or the opposite of, I thought I was doing way better than that this year, what happened? You've got time to review and understand all of the pieces. And so you're going into 2025 having a solid feel for where things were going in 24, kind of what your results were. And then the third one is the ability to act. Anytime you are going towards the end of a year, the more you are ahead of the game, the more your financials are up to date now, not kind of in a pile you're going to give your accountant in the spring, the more power you have to make choices. Say that thorough review shows you're way more profitable than you were expecting to be this year, or you thought you were. You now have the ability to make some choices to accelerate some spending, things like that. And I don't want to jump ahead too much because I will spoil my next few slides. But doing your end of year prep, being organized, giving yourself time to look through your books, to meet with your advisor, whoever that may be, to talk about them and understand them, and then make some strategic choices based on how you can act is really why you want to take the time to have your end of year reviewed and be up to date leading into the new year. So along with that, we put together, these are not the only pieces of things, but 5 best practices that we have that we suggest doing and considering in the end of the year. Most of this is not a heavy lift. So it's stuff that even as, we're in these last few weeks, Christmas is upon us before we know it, and that time off around there are still things that you can do, still some choices you can make, and to be strategic going into 2025. The first piece is really kind of a rehash of what I just talked about, but the first best practice is to make sure you are up to date and you're ready to go. That's making sure that your books are recorded, you've got those accurate year-to-date financials so that you can see how things have gone so far this year. You can make decisions based on that. Also helps you find and remember what you've already paid in estimates, either to your state or to the IRS. So you know already going in, hey, I've already put in $10,000 towards my 2024 tax liability. Here's where my profitability is. Here's what I should expect. And then that last one is there any spending that I don't have in here already? Did I go out and have a business trip where I ran to Costco and I stocked up a bunch of stuff for the office, but I put it on my Costco card rather than the business card, whatever that is, making sure that every penny you spent for the business, even if it didn't run through your business checking account, is accounted for in your financials, because every dollar is just a little bit of tax savings. The second one is based on how that goes, review for any spending that you can pull ahead. If you finish that first step, you're like, hey, I got a lot of profitability here. I would love to offset a little of that going into 2025, just so my tax hit in April isn't so big. Do you have time at this point in the year to do sweeping big tax strategy changes? Probably not. But what you do have time to is to look for what I like to call the low-hanging fruit. What am I going to spend anyway that I can pull ahead? Paying for marketing and leads, paying for rent that you're going to use, your January rent, you can pay that on December 30th, December 31st. A common one is look ahead to what your team's equipment. Are they going to need new office chairs, new computers, anything like that in the next few months that you can do now? Put those orders in. Additional marketing materials. Anything else that you're looking ahead and going, hey, I'm really kind of thinking about this in January. Do that in December. Do that Costco trip and stock up on office supplies. When you're doing this, the important thing is really to think about doing spending. I call it strategic spending. Spend things that you are going to spend anyway, or that make sense and help your business. Either, like these ones are very much, you're going to spend them anyway. It's just a matter of timing. If you're going to do an investment into something that maybe you weren't going to do, but now you see you have some extra funds to do it with, and you'd really like to drop that tax liability, do it in something that you are reinvesting in your business and you're going to see the rewards for. When you spend, you do not save $1 of taxes for every dollar you spend. So if you're looking and saying, hey, I think I'm going to owe about $10,000 of taxes this year, you're not going to go out and spend $10,000 and then owe 0 taxes. You're going to save essentially what your effective tax rate is. Usually that's anywhere from 15 to 20%. So if you say, hey, I need to go spend $10,000 to save my taxes, you're not going to see 0, you're going to see 8. You'll have saved roughly $2,000 in taxes if you spend down that $10,000. So it is not something to just throw money away. It's not something to spend for the sake of spending, because you will spend more than you will save. And so at the end of the day, if you are spending something that you're not reinvesting and you're out $10,000 and your taxes only dropped 2, you actually lost $8,000 because you only recouped the savings of the 2,000. So, and that's something to always keep in mind. Any tax strategies you're looking at, for the bulk of them, you've got to spend money to save money. And so it really comes down to spending strategically. Don't just spend because you don't want to pay taxes. Because if you spend money and get down to 0, great, you didn't pay taxes, but you also don't have any money to reinvest into your business or into your personal life down the road. The next space to take a look at is any retirement plans that you already have access to. There are 3 most common ones that we see, all with different maximum contributions that you can defer some income down the line. So if you are an S corporation and you are on payroll as an owner of your business, you have the access to potentially, depending what you're providing, maybe a simple IRA or a 401k that you were providing as an employer, and you as the employee can contribute to that and defer some of your salary to be taxed down the line. So these do have to be traditional plans, not Roth plans, because traditional plans are taxed later when you pull them out. Roth plans, you pay taxes now, but then you're not taxed down the road. So this all kind of plays into whatever full strategy you have as far as with your financial advisors and any retirement planning you're already doing. A lot of people have kind of a mix of traditional and Roth that they're utilizing for their future plans. But if you do have a traditional that you are working with, this is a great option. And so with a simple IRA, you can contribute up to $16,000. That does have to be done by December 31st. And many of you, often what happens is you've done a little bit throughout the year, you've done the matching of whatever you kind of do for your employees. And so you can figure out the difference. Hey, I've already put in 3,000, I'm going to put in another 13. You make that contribution, and then you go ahead and what that will do is on box 1 of your W-2, it's going to reduce your taxable wages by the total amount you've contributed to your simple IRA. The 401k is the same process, except it's even a higher max. And these are the baseline. So there are also catch-up periods for if you're over 50. I will admit, I don't know those off the top of my head because the IRS changes them most years, but this is basically the minimum, maximum, depending on your age. So for the 401k, it's $23,000 this year. You need to make sure it gets onto your W-2 as well, and that one is also December 31st. The most flexible is the traditional IRA. That is one that we don't have to be employees to have, or we don't have to have it through our employers. Any of us who have earned income potentially have access to it, depending on our income levels. That one, the max is only $7,000, but you also have until April 15th to contribute that. So through April 15th of 2025, you can designate a $7,000 max contribution to your traditional IRA for the 2024 tax year. Sorry about that. And so the one thing to keep in mind is I have the maximums here. Anything in between still helps you. So the maximum you can contribute is 16,000. You're saying, hey, I've got a simple, I've only got 5,000 that I feel comfortable deferring in. Using that roughly 15 to 20% tax savings we were talking about before. All right, I'm going to put $5,000 in, so I just saved $1,000 on taxes with that 20%. So again, just like the last slide on this is the common theme, like I mentioned, you're not going to save 100% of tax, the same dollar for dollar on taxes that you contribute. So it is something that you kind of have to weigh the pros and cons. Is it worth locking up $5,000 into my retirement where I can't access it right now to save that on taxes? It often is. But you might say, no, I really don't have that spare cash right now. I'd rather pay the extra $1,000 in taxes. The fourth one here is another just organizational one, is that if you are an S corporation, if you are on the payroll of your company, please make sure all of your benefits are correctly put onto your W-2. A lot of times benefits for owners are not paid directly through your payroll provider like our employees are. A great example of that is owner's health insurance. Which on the State Farm side is paid half by you and half by State Farm, generally speaking. And it comes through your comp deducts. That's not going, Gusto's not recording that for you every pay period, but it does need to get onto your W-2. So making sure any health insurance, dental, vision that you've been paying for yourself gets onto your W-2. And then any contributions to retirement plans like we were just talking about. You can go ahead and you can make that contribution to max that out personally or out of a different account, but then you need to go to your payroll provider and say, hey, I have an additional benefit that was paid outside of the system so that they adjust it correctly. So both of those need to get on as well as anything else that you may be paid outside the system, whether it was bonuses for your team, bonus to yourself, anything like that, making sure that all is going through payroll. Payroll providers tend to have a really tight turnaround in January because they've got a whole lot of W-2s to spit out. So Gusto, for example, that we work with really closely, generally their deadline to get that owner's health insurance onto a W-2 is like the 6th or the 7th. When you factor in holidays, that's not very long to make sure that gets updated. So if you know how much that's going to be, if you know that last little payment that you're coming through, you can let them know about it now. If you make that funding payment for the retirement, let them know as soon as you go through it so they can make sure to get that updated. If you wait until you're kind of doing all the December accounting and things are kind of wrapping up on the middle of January, it's going to be too late. And then you would have to do an amended W-2, which some payroll providers charge you for, others don't, but you're just kind of creating more paper trail and more paperwork. The last thing to consider is something called a pass-through entity election. This is available in many states, not all, and it is something that is really related to the 2018 tax reform. The 2018 tax reform, one of the many changes it made was it maxed out the amount of state and local taxes, or SALT taxes, you'll also often see it called, that an individual is allowed to deduct as an itemized deduction. Every one of us on our personal taxes takes either a standard deduction or the total of all of our itemized deductions, whichever is higher. Our itemized deductions are things like real estate taxes, state income taxes, mortgage interest, charitable contributions, medical expenses. Those are the big ones. And so if we have paid more than the standard deduction and all those expenses in any given year, we take that total. If it's less than the standard deduction, we take the standard deduction. So a standard deduction is really the baseline, the minimum you'll get to take is that write-off. So with the pass-through entity, with that $10,000 cap, many states, especially the higher income states, were very affected by it. California, New York, places where the individual income tax rate is really high, almost everybody in those states was going above $10,000 when you combined their real estate taxes and their state income taxes. Many of them, even without real estate taxes, they were already over the $10,000 mark. So it really impacted them and limited what they could write off. And so what many of the states did is they said, hey, we can't help everybody, but we can at least help business owners. And so they created this election that says for a business, a pass-through entity, so a partnership or an S corporation, if you want to, what we'll do is we'll create an avenue where you can make an election to pay taxes through your business instead of pay taxes personally. So generally speaking, the states, just like the IRS, on a pass-through entity, you don't pay any taxes at the business level. You file a tax return, but you don't pay any taxes at the business level. All of that income passes through the business onto your personal return, and that's where you pay the taxes. And then the state taxes go into that itemized deduction. If you make the election to pay the state taxes at the business level, then you're still paying the state kind of the same amount of taxes because they're not going to charge you on it twice. They'll either give you a credit or there'll be an adjustment depending on how they do it. But you're going to just pay taxes on the same income, but you're doing it in a different place. And what that does is it makes it a business expense, not a personal expense. And so when you go then report it to the IRS, it is that much lower. So say you're doing great, you've got great profit, and you have $50,000 state and local state tax, and you make that pass-through entity tax election. That's essentially a $50,000 additional write-off that you will be able to take on your federal tax return. And so there are really great savings often with this if you are in a state that allows it. Each state has slightly different requirements, so you do want to make sure you understand your state's requirements. The state of New York, for example, is, I think, from what I have found, the most restrictive one, and that they require you to make that election by March 15th of the current year. So for 2024, you would have had to make the election to be a pass-through entity by March 15th. But looking ahead for 2025, you can make it for next year, but you have to make it for next. Most of them are not that restrictive. Most of them say either by December 31st, or honestly, the majority say with a timely filed tax return. So you can be filing your tax return in March or your extended tax return in September, and then choose to make that election, which is great because it gives you the flexibility to see if it's actually the right thing or not. If you are going to do that and you want to see the maximum 2024 tax savings, though, you should make an estimated payment at the state level through your business by December 31st. And that's because the vast majority, if not all, of the agents we work with pay their taxes on a cash basis. So when you spend the cash is when you get to write it off. If you don't get it in by December 31st, then decide next year that you do want to make the election. That's fine. It's still going to save you taxes. It's just a 2025 write-off instead of a 2024 write-off. So those are our 5 kind of low-hanging fruit items to kind of think about throughout the next few weeks. And then lastly, I did want to give some updates on what 2025 is looking like. Just things to keep in mind, things to expect as you're going into next year and want to continue to be strategic about choices you make starting all the way on January 1st. So I am calling, this is me personally, I haven't trademarked it yet, maybe I will. This the last, maybe, year of the status quo. And what I mean by that is I referenced the 2018 tax reform earlier when it came to the state and local taxes cap. The 2018 tax reform, the Tax Cuts and Job Act, many of the things, provisions, and the changes in that act are currently set to expire at the end of 2025. So 2025 itself is going to look very similar. There is the adjustment for the bonus depreciation that I have over here. That has been phasing out again since 2018. So it's going to continue to do so for 2024. It is 60%. For 2025, it's going to drop down to 40%. And what that means is accelerating additional write-offs for things like cars, computers, anything over $2,500 that you can't expense in the first year. Used to be bonus depreciation was 100% back in the good old days. Been phasing out, obviously. So here in 2024, if you buy a computer for, or buy computers for $10,000, you can write $6,000 of them off this year. In 2025, it'll be $4,000. So that is something to keep in mind when we were talking about accelerating spending. On an earlier slide, is it'll get a little lower for 2025. So if you have any big investments you need to make in the office, whether it's chairs, things like that, anything you can get in here in 2024 in December, you'll be able to get that a little bit of accelerated write-off. So it won't change what you write off over time, but rather than write it off over 5 years, you can pull more of it into this year, and we all like to see those tax savings this year, and then deal with 3 years from now, 3 years from now. So when it comes to that Tax Cuts and Job Act, the big one that is set to expire at the end of 2025 that is incredibly impactful for small business owners is the qualified business income deduction. What that is right now is that for your business income, for your agency income, any other business you have, not your wages, you get right now a 20% deduction of the net income, the taxable income from that business. So if you have $1,000 net income from your agency, you're seeing a $20,000 write-off deduction from your taxable income. That is hugely impactful. That's big. That's 20%. That's big, especially as you grow and if you're growing. That is set to go away at the end of 2025. And so if that continues, if that does not change, if it doesn't get extended, that could create some really interesting tax planning opportunities at the end of next year. Because a lot of the things that I've talked about today, recommendations for 2024, I maybe wouldn't recommend at the end of 2025 if that continues to be the case, that it's going to go away at the end of 2025. I would rather, most likely, keep income a little bit higher for 2025, where you know you're going to get that 20% write-off, and obviously the write-off's bigger if the income's bigger, and then push some expenses that maybe you'd spend in December of 25 into 2026. So when you lose that 20% write-off, you offset it with some additional spending. The increased child tax credit is currently $2,000. That is set to drop back down to $1,000. That state and local tax cap we talked about in so much detail is also set to expire. And then just overall, they had dropped all of the individual tax rates and brackets down a bit. Those are set to go back to pre-TCJA rates as well. All of that aside, that could all change depending on what happens in the next few months. We have a new administration coming in January. They seem to have more agreement on Capitol Hill than has been there in quite a few years. And so there's a good chance that all of this becomes null and void because all of these things that are expiring get extended. The 2018 tax reform was passed by President Trump. President Trump is the one coming back into office, as we all know. So it's very likely that he wants to protect his legacy. And if he has enough support in Congress to do so, I could definitely see that this would be something that they would extend either for another few years, kick the can down the road, or make permanent. The bonus depreciation I have been kind of holding out to see come back. In the same vein, with the current administration who's coming in, it probably will continue to go away if I had to venture a guess. Again, because that initial phase out came from the TCJA from the last time Trump was in office. So my my next year is going to be interesting because I'm going to be tracking this very closely. I do not have a crystal ball, and given kind of the uncertainty of the past few years, if I had one, I don't think I would trust it. But I would really kind of encourage some conservatism, some caution going into the first half of the year. I am not telling anybody right now to make any drastic decisions for 2025 because anything you do in February, depending on how the first few months of the administration go, could be detrimental down the line, depending on how things play out. So it really kind of encourage, as you're looking forward to 2025, as you're thinking about tax planning, try to kind of stay steady, have some stuff in the back pocket, work with your tax advisors as you finalize your 2024 returns, see what makes sense. Definitely make all your estimated tax payments quarterly, but kind of wait to see how things balance out and play out a little bit. I know that I just saw something the other day that Trump has said this is one of his priorities in the beginning when he gets in he's expressed that he is very interested in extending this or making it permanent. So we may know sooner rather than later. But it takes time for everything to run through. Even if it is the most straightforward of proposals, we all know that it takes time to work through the system. So a lot, I think, that we'll know in the second half of 2025. That we'll either be able to say, hey, not a lot's changing. We can kind of continue with a lot of these strategies we've been using. Or, hey, nope, they didn't make it through. They're changing stuff up. 2026 is going to look drastically different again. Let's think about strategies, not just for 2025, but looking ahead to what 2026, 2027 are going to look like if these items don't get extended, because that I think will cause a lot of changes, especially for small business owners with that qualified business income deduction, just strategies to think about, timing of expenses to make sure that you can maximize the tax savings while also reinvesting in your business and your business's growth. That is what I have. So not a ton of like specific not a ton of different items to go into, but really some stuff that I think didn't want it to be things that you have to go spend 5 hours on, do some insane tax planning to go through, but some things that I think even just in the next couple of weeks, some easy lifts, just some reviews of spending, and then really thinking about long term. Maybe more just an attitude of bracing yourself and being ready to not know for sure what's going to happen in these next few months until we get some additional details on what they're going to do with those expiring tax items. I don't see any questions in the comments. If you have them, please feel free to throw them out there. I'll stay on for a minute or two here. But otherwise, I really appreciate everybody joining us. It is great to share some tips and tricks with you going into the new year. If you have any questions, please don't hesitate to reach out. The easiest way to get a hold of me is tax@club.capital. And I'm happy to provide any other additional tips or feedback, clarity on some of the things that I have talked about today. All right, I'm going to go ahead and close this out because I don't see any questions coming into the chat. Thank you all so much for joining us and have a great rest of your day.